The silent threat most 73-year-olds face this year is not in the stock market, is not in their Medigap supplement, and is not in their Social Security. It is sitting quietly inside their own traditional IRA and rollover accounts, a required minimum distribution deadline that most people either forget about, postpone incorrectly, or accidentally double up in a way that creates a tax disaster they could have easily avoided. If you turned 73 in 2026, you crossed an invisible line in the tax code. Under Secure 2.0, the age at which you must begin taking required minimum distributions from most tax-deferred retirement accounts is now 73. Your first RMD is due, and the rules give you a specific one-time opportunity. That looks like a favor but can turn into a tax trap if you use it without planning. You can delay your very first RMD until April 4th of the year following the year you turn 73, which for 2026 turners means you can delay until April 1st, 2027. That sounds generous. It feels like a free pass. What most retirees do not realize is that if you use that delay, you will be forced to take 2 RMDs in the same calendar year, 2027, one for the 2026 tax year and one for the 2027 tax year. 2 distributions stacked together, potentially pushing your 2027 adjusted gross income into a much higher bracket, triggering RMD surcharges, increasing Social Security taxation, and permanently costing you thousands of dollars in avoidable tax. The April 1st extension is sometimes a useful tool, but it is rarely the automatic smart move most retirees think it is. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Now, let us carefully walk through how first-year RMD timing actually works, when the April 1st extension helps, when it hurts, and what you need to do before December 31 of this year. The required minimum distribution is the annual amount the IRS forces you to take from traditional IRAs, rollover IRAs, SPIRAs, simple IRAs, 401k plans, 403b plans, 457b governmental plans, and most other tax-deferred retirement accounts. Roth IRAs do not require RMDs during the original owner's lifetime. Under Secure 2.0, Roth 401k accounts also no longer require RMDs during the owner's lifetime for tax years 2024 and beyond, which eliminated a long-standing mismatch between Roth IRAs and Roth 401k rules. The specific amount of your RMD each year is calculated by dividing your prior year-end account balance by the life expectancy factor from the IRS Uniform Lifetime Table, found in publication 590B. At age 73, the factor is 26.5, which means your first RMD is roughly 3.77% of your balance as of December 31 of the prior year. For a retiree with a $600,000 traditional IRA balance, on December 31st, 2025, the 2026 RMD is approximately $22,700. For a retiree with a $1.5 million balance, the first RMD is approximately $56,600. Here is the specific timing rule that catches most people. For all years except the very first, your RMD must be taken by December 31st of that year. For the very first year, the year you turn 73, you have a special one-time option. You can take the first RMD by December 31st of that year, the same as every future year, or you can delay it until April 1st of the following year, which is called the required beginning date. If you delay, you must still take the next year's RMD by December 31 of that same following year. So if you delay your 2026 RMD until April 1st, 2027, you must also take your 2027 RMD by December 31, 2027. Both distributions land in 2027. Now the math on why this can be painful. Suppose you have a $1 million traditional IRA on December 31st, 2025. Your 2026 RMD is approximately $37,700. Your 2027 RMD, based on your balance at the end of 2026, might be approximately $39,000, depending on growth and the 2027 factor of 25.5. If you take your first RMD in 2026, your 2026 taxable income includes $37,700 from the distribution, plus Social Security, plus pensions, plus any other income. Your 2027 taxable income then includes $39,000 plus other income. Income is spread across 2 years, kept modest in each, and tax brackets, RMD tiers, and Social Security taxation percentages stay in favorable ranges. Now look at the delay scenario. If you skip the 2026 RMD and wait until April 1st, 2027 to take it, you take both the 2026 and 2027 RMDs in the same calendar year. Your 2027 taxable income now includes approximately $76,700 from RMDs, on top of Social Security, pensions, and everything else. For a couple already in the mid to upper margin of the 22% bracket, that extra distribution can push them firmly into the 24% bracket. Cross the second RMA threshold, triggering an extra $2,000 in Medicare premiums for 2029, and increase the taxable portion of their Social Security benefits. The total additional cost of the delay, in a typical case, can easily exceed $5,000, and the delay provided no underlying benefit. The money was always going to be taxable. The only question was which year. Frank and Eleanor, a married couple both in their 70s from Gainesville, Florida, made this exact mistake in 2024. Frank turned 73 in 2024 and delayed his first RMD until March 2025. He also had to take his 2025 RMD by December 31st, 2025. Combined, those two RMDs totaled almost $90,000 in a single calendar year. The spike pushed the couple's joint income across the second IRMA threshold, which hit them in 2027 with elevated Medicare premiums for both spouses, totaling roughly $3,200 extra for the year. Their accountant estimated the total additional federal tax, state tax, and ERMEA cost of the delay at just over $6,000, all avoidable if Frank had simply taken the first RMD in 2024 as normal. That said, there are specific situations where the April 1st delay is actually the right move. Let me walk through when it helps. The delay helps most clearly when your income in the year you turn 73 is unusually high for reasons unrelated to the RMD, and your income in the following year is expected to be significantly lower. For example, suppose you receive a large severance payment in the year you turn 73 because you are retiring that year. Your earned income plus severance plus RMD could push you into a materially higher bracket. If you expect the following year to have a much lower base income, delaying the first RMD to the following year, even though it doubles up with the second RMD, may still result in a lower total tax bill, because the first RMD is taxed at a lower bracket. The delay can also help if you expect tax law changes that would increase rates in the year you turn 73, making it advantageous to push the income into the next year. This is a specific and unusual circumstance, but it occasionally applies. The delay may help if you have a large specific deduction planned for the following year that is not available in the current year. For example, if you plan a large charitable contribution in the following year through a donor-advised fund or qualified charitable distribution, the RMD income might be fully or partially offset by the deduction in the same year, reducing the tax impact. In most other cases, the delay creates more problems than it solves. The default recommendation for most retirees is to take the first RMD in the year you turn 73 by December 31st of that year, and continue taking subsequent RMDs by December 31 of each following year. Consistency is cleaner, produces smoother tax outcomes, and avoids the double-up trap. Let me walk through the specific mechanical steps for taking your first RMD cleanly. Step 1. Determine your December 31st, 2025 account balance from every tax-deferred retirement account you own. Include traditional IRAs, rollover IRAs, SIP IRAs, simple IRAs, 401k, plans from former and current employers, 403b plans, 457b, governmental plans, and any inherited traditional IRA you might hold from a deceased spouse. Your custodian statements typically display this balance clearly. Step 2. Calculate the RMD for each account separately by dividing the account balance by the Uniform Lifetime Table factor for your age. For most 73-year-olds, that factor is 26.5. However, if your sole beneficiary is your spouse, and your spouse is more than 10 years younger than you use a different table called the Joint Life and Last Survivor Expectancy Table, which produces a lower RMD. Step 3. Understand the aggregation rules. For traditional IRAs, you can sum the RMDs from all your IRAs and take the total from any single IRA or any combination. You have flexibility. For 401k, 403b, and other employer plans, each plan requires its own separate RMD distribution from that plan. You cannot satisfy a 401k RMD by taking distributions from an IRA, and vice versa. 403b plans have a limited aggregation rule among them, but it does not cross into IRAs or 401ks. Step 4. Request the distribution from each relevant custodian. Most custodians have an online RMD distribution form. You specify the amount, the payment method, and the withholding you want. Federal tax withholding on IRA distributions defaults to 10% unless you elect otherwise. You can elect 0% withholding if you prefer to pay estimated taxes through 1040 ES, or higher withholding if you prefer the convenience. State tax withholding depends on your state. Step 5. Verify that the distribution is complete by December 31st, or by April 1st if you are using the first year delay. Custodians typically process distribution requests within 3 to 5 business days, but end-of-year processing can slow down. Do not wait until December 28th to initiate the request. Start the process no later than mid-November to avoid end-of-year bottlenecks. Step 6. When tax filing comes in April of the following year, confirm that the distribution is reported correctly on Form 1040. The custodian will issue a Form 1099-R. The RMD amount should appear on line 4A as the gross distribution and on line 4B as the taxable amount for traditional IRA distributions. For 401k and 403b distributions, the amount appears on lines 5A and 5B. Your tax preparer or tax software should handle this correctly, but review before signing. Let me walk through 3 critical traps. Trap 1. Missing the RMD deadline entirely. If you fail to take the full RMD by the applicable deadline, the excise tax penalty under Secure 2.0 is 25% of the missed amount, reduced to 10% if you correct the shortfall, promptly within a correction window defined in the rules. You report the penalty on Form 5329, and if you have reasonable cause for the shortfall, you may request a waiver. Common reasonable cause scenarios include illness, natural disaster, or reliance on professional advice that turned out to be incorrect. The IRS has historically been relatively forgiving of first-time shortfalls when corrected quickly, but do not count on forgiveness. The better move is to not miss the deadline in the first place. Trap 2. Taking the RMD from the wrong account. You cannot use an IRA distribution to satisfy a 401k RMD. You cannot use a 401k distribution to satisfy an IRA RMD. If you have multiple account types, you must take the correct RMD from each type separately. Many retirees have both 401k balances at former employers and IRA balances they rolled over from prior jobs. Treat each type separately and make sure you satisfy the RMD requirement in each category. Trap 3. Forgetting about inherited IRAs. If you inherited a traditional IRA from someone other than your spouse, that account has its own separate RMD requirement, typically on a different schedule than your own accounts. Under the Secure Act 10-year rule for non-spouse beneficiaries of accounts inherited in 2020 or later, the account must be fully distributed within 10 years, and depending on whether the original owner had reached RMD age before death, there may also be annual RMD requirements during the 10-year window. This is one of the most frequently missed requirements in retirement tax compliance, and the IRS has issued specific guidance for 2024 and 2025, providing penalty relief in certain cases. If you hold an inherited IRA, confirm your specific RMD obligations with a qualified tax professional. Now let me walk through a protective framework for anyone who turns 73 this year. Framework Step 1. Calculate your RMD for 2026 and create a calendar reminder for November 1st to initiate the distribution. That gives you 8 weeks of buffer to complete the distribution before December 31st. Framework Step 2. Run a quick tax projection for 2026, including the RMD amount, all other income, any planned deductions, and estimated state tax. Compare that to your projection for 2027 without a doubled-up RMD. In most cases, the single RMD year will produce meaningfully lower total tax. Framework Step 3. Decide whether to use the qualified charitable distribution option. If you are charitably inclined, QCDs from your IRA count toward your RMD but are excluded from taxable income. A well-timed QCD can reduce your RMD taxable impact substantially. Framework Step 4. Decide your withholding approach. Many retirees elect to withhold federal tax directly from the RMD distribution, which covers their federal tax liability without needing to make separate estimated payments. Unlike wages, withholding from RMDs is considered to have been paid evenly throughout the year for underpayment penalty purposes, which can be a useful mechanic for those who missed earlier quarterly estimated payments. Framework Step 5. Coordinate with any Roth conversion activity. If you have been running a Roth conversion ladder and you reach RMD age, the RMD must be taken before any additional Roth conversion amounts are executed. You cannot convert RMD dollars to Roth. The first dollars distributed from the IRA in any year in which an RMD is required are considered to be the RMD, up to the full RMD amount. Any amount above the RMD can then potentially be converted to Roth, subject to your broader tax planning. Ruth, a retired seamstress from Erie, Pennsylvania, built a particularly clean approach. She turned 73 in February 2026. She took her full RMD of $31,000 in November 2026. She sent $12,000 of that as a QCD to her church and an animal rescue organization, reducing her taxable RMD portion to $19,000. She elected to have 18% federal tax withheld on the $19,000 taxable portion, covering her additional federal tax without needing separate estimated payments. She repeats the process every November going forward, keeping her tax situation smooth and predictable. No surprises, no stacked distributions, no IRMA thresholds accidentally crossed. The first RMD year is not a crisis if you plan it, It is an opportunity to establish the annual rhythm that will guide you for the rest of your life. Set the date, run the calculation, check the QCD. Option, verify the withholding, and do it by December 31st. The April 1st delay option exists for unusual circumstances, but for most retirees, it is better to ignore it entirely. One more planning insight for first-year RMD takers. Many retirees assume that once they set up their first RMD, the custodian will automatically calculate and distribute subsequent RMDs each year. This is partially true. Most major custodians do offer automatic RMD calculation and scheduled distribution services, but you must typically opt in and specify your preferred distribution timing, frequency, and withholding. Check with each custodian separately. If you have accounts at 3 different custodians, all 3 must be set up individually. Do not assume one custodian communicates with another, because they do not. Each custodian tracks only the account it holds. Another helpful planning detail. RMDs do not have to be taken in a single lump sum. You can spread them across the year, taking monthly or quarterly distributions, which can smooth your cash flow and tax withholding. For retirees who prefer a steady income pattern rather than a single year-end deposit, monthly RMD distributions replicate the rhythm of a pension check. Most custodians support this easily through their standing instruction services. Set it up once, and it handles itself for years, with the custodian recalculating the annual amount each January based on the prior year-end balance. If this framework helped you understand a year you might have otherwise stumbled through, please subscribe for next week's walkthrough of the backdoor Roth IRA and the pro rata rule, where we show you exactly why some high-earner retirees are accidentally creating unexpected tax bills every time they try to fund a Roth. Share this video with anyone you know who just turned 73, because the rules are easy to handle once you understand them and impossible to undo if you miss them. Thank you for watching, take care of yourself, and I will see you in the next one.